RUM Group crushed Q2 2026 revenue consensus. I mean, they posted a record $40.37 million against Wall Street's $34.93 million estimate. But they missed the bottom line heavily, reporting a GAAP EPS of negative 28 cents versus the expected negative 9 cents.
Right, but then management turned around and initiated their first ever formal Q3 revenue guidance at a massive $87 to $93 million.
And the stock reaction was just pure whiplash. It initially dropped nearly 3% on earnings day, dipped even further after hours, but then surged over 11% the following day.
Yeah, that 24-hour reversal is honestly one of the most fascinating market reactions we've seen this quarter. You had these high-frequency trading algorithms dumping the stock based on the headline EPS miss, completely oblivious to the underlying fundamentals.
Exactly.
Then human investors woke up, read the actual filings, and just aggressively bought the dip.
It's wild. I mean, imagine your favorite online consumer video app. You know, the one you might use to watch gaming streams or like political vlogs. Now imagine that same company secretly buying up tens of thousands of the most advanced, scarce AI superchips on the planet.
It sounds like a sci-fi plot.
It really does. But today we are deep diving into RUM Group's bizarre, brilliant, and honestly, highly risky overnight transformation. They went from a pure-play consumer media site into a massive artificial intelligence infrastructure powerhouse. We're going to unpack the financial realities behind this pivot, decode that massive variance between the algorithmic and human market reactions we just mentioned, and figure out what this means for the company's future.
And, the foundation of this entire story really is that EPS miss. When an algorithm scans an 8K filing, it just looks for the top and bottom line tags. It sees a widened GAAP net loss of $79.1 million, flags that negative 28 cents per share, and instantly triggers sell orders.
Right, it doesn't read the footnotes.
Exactly, it doesn't read the footnotes.
And as a retail investor, if you only read those algorithmic news tickers, you'd think the core business was bleeding cash. But looking at the breakdown here, that widened loss wasn't an operational failure. It was almost entirely driven by $33.2 million in acquisition-related transaction costs.
And that is the crucial distinction. Because when a company executes a billion-dollar merger, you have a massive influx of one-time accounting hits. Investment banking fees, legal costs, immediate write-downs. It is the temporary cost of buying an empire.
Yeah.
When you strip out that M&A noise and look at their actual day-to-day operational cash burn, their adjusted EBITDA actually narrowed. It dropped to a loss of $16.6 million, which, that's an improvement from a loss of over $20 million a year ago.
Which perfectly explains why the human investors reversed the algorithmic sell-off the next day.
Yeah.
The algorithms basically saw a breakup text message and bailed. The human analysts kept reading and saw, the underlying business is actually getting more efficient.
Right.
And they also saw the catalyst for that $33 million M&A charge, which was the closing of just a monumental deal.
Yeah, on June 17th, 2026, the company officially closed a roughly $1.52 billion acquisition, securing an 85.2% stake in Northern Data AG. This wasn't just like a strategic partnership. It was a fundamental corporate DNA swap.
They even changed their name. Rumble Inc. officially became RUM Group Inc. They structured themselves as a holding company with two distinct, supposedly synergistic business units.
Right.
So you have the legacy Rumble video platform on one side, and on the other side you have Quake AI, this newly formed absolute behemoth of a cloud and AI infrastructure business.
And Quake AI didn't just exist on paper. In the final 2 weeks of the quarter, literally just the 14 days following that June 17th close, Quake AI contributed $10.1 million in colocation and cloud computing revenue.
Wait, in 2 weeks?
2 weeks.
That is an incredible revenue run rate, and is driven by the sheer scale of the hardware they acquired, right?
Mm-hmm.
Quake AI currently controls roughly 22,000 NVIDIA H100 and H200 GPUs.
Yeah, it's a massive stockpile.
If you are tracking the tech sector right now, you know those NVIDIA chips are the absolute gold standard for AI compute. Everyone from OpenAI to Tesla is fighting over allocations, and RUM Group is just sitting on 22,000 of them.
And they are running them at an 85% utilization rate, which is a highly efficient operational metric for hardware of that caliber. But the real story here, the thing that really stood out, is the business model shift that CFO Mike Massey laid out on the call.
Oh, the powered shell thing.
Right. So the traditional data center play in this space is what's known as a powered shell model. A company secures the real estate, brings in the massive power grid connections, and essentially rents out the empty space to tech companies who bring their own servers.
Right. If you're listening to this and wondering why data centers are so profitable, it's about the power density. But that powered shell model only generates roughly $1.5 million to $2 million per megawatt per year.
Exactly.
It's like leasing out a patch of dirt that just happens to have high-voltage power lines running to it. It's reliable, but it's a low-margin landlord business.
Yeah, and Quake AI is bypassing that entirely. They are offering AI compute as a service using next-generation Blackwell chips. So they aren't just providing the power. They are providing the hyper-advanced servers, managing the networking, and handling the software stack. According to management, this model can generate almost $11 million per megawatt per year.
Wait, 11 million?
Almost 11 million, yes.
That is nearly a 5x multiplier on revenue for the exact same amount of electrical power. They're basically moving from leasing dirt to building a hyper-advanced, fully staffed manufacturing facility where clients just upload their code, and Quake AI servers manufacture the AI models.
The economics are staggering, well, assuming they can execute.
Right, and that's where I'm struggling with this part of the thesis. Selling AI compute at an $11 million per megawatt run rate sounds incredibly lucrative, but it's not just plugging a server rack into a wall outlet.
No, not at all.
These H100s, they literally melt if they aren't cooled properly. You need massive liquid cooling infrastructure, specialized transformers, advanced networking to prevent bottlenecks. Does a legacy video streaming company actually have the engineering chops to operate the most complex machinery in the world?
It's a fair question, and analysts actually pushed them on that exact operational risk during the Q&A. The defense RUM group offered is twofold. First, they didn't rely on big tech cloud providers to build their video site. They spent years building their own bare metal compute infrastructure and global content delivery networks.
Okay, so they're used to heavy lifting.
Right. They know how to manage heavy, high-bandwidth data centers. And second, that is exactly why they spent $1.5 billion on Northern Data. They acquired a company that has been doing high-performance compute as a service for years.
So they bought the operational expertise. And the market seems to believe they can deliver because they just announced a massive multi-year deal with Together AI to deploy NVIDIA HGX B300 GPU capacity. You don't land a contract with a premier AI developer unless your supply chain and your engineers are top tier. NVIDIA won't even allocate those B300 chips to you if they think your data center is going to bottleneck them.
Yeah, that contract essentially validates their position in the supply chain, which makes their 2027 master plan start to look less like a pipe dream and more like, well, a realistic trajectory. Management's primary focus moving forward is lighting up 250 megawatts of currently unmonetized power targeted for 2027.
And the crown jewel of that master plan is a 180 megawatt site near Atlanta, Georgia. Just to put 180 megawatts in perspective, that is enough electricity to power a medium-sized city.
It's huge.
When CEO Chris Pavlovsky was mapping out the economics on the call, he stated that simply monetizing this 250 megawatts represents a $3 billion plus annual revenue run rate opportunity.
It really forces you to completely reevaluate the scale of this company. I mean, we are talking about a business that just celebrated a $40 million quarter as an all-time record, and they are projecting a line of sight to a $3 billion annual run rate.
But this brings up the fundamental paradox of this entire deep dive. Why combine a consumer video platform with a B2B AI compute infrastructure company? If Quake AI is this absolute juggernaut, why drag the Rumble video platform along with it? Is this synergy real, or is management just, using buzzwords to justify mashing two completely different companies under one holding umbrella?
Pavlovsky's explanation of the synergy was arguably the most forward-looking part of the earnings call. He outlined a massive shift happening in the AI industry right now, transitioning toward what he calls the robotic and agentic AI era.
Okay, let's unpack that. Because up until now, the AI boom has been driven by large language models, basically chatbots.
Exactly, and those models are trained on contextual data. They scrape millions of pages of text from sites like Wikipedia or Reddit. That is perfect if you want an AI to write an email or summarize a legal document. But text has hard limitations.
Right.
If you want to train a physical humanoid robot how to walk across a crowded warehouse or how a tennis ball bounces off a wall, reading a million words about physics just won't help it.
It needs to see it.
Yeah.
It needs spatial temporal data, space and time.
Video. Video data teaches an AI about physics, depth perception, movement, and human interaction in a three-dimensional environment. The next generation of autonomous AI requires video training data to understand the physical world.
Think about the videos you uploaded last week. The vlog of you walking down the street, the gaming stream, the sports highlight. That spatial temporal data is the exact fuel needed to teach a robot how gravity works. Pavlovsky noted that their existing AI clientele at Quake are already expressing active interest in Rumble's video data archives.
Yeah, and he drew a direct parallel to the broader market, pointing out that Amazon is already exploring ways to tap into Twitch's video data to train their models. RUM Group has a unique structural advantage here.
He had a quote on the call that really crystallized the entire pitch. He said, "We have data, we have the rails, and we have the community to power the future of AI." So they aren't just going to rent out the supercomputers, they are eventually going to sell the AI developers the textbook, the video data needed to train the next generation of models.
And critically, this creates a potential new monetization bucket for the content creators on the legacy platform. If their spatial temporal data is licensed for AI training, it could establish a completely new revenue stream outside of the notoriously volatile digital advertising market.
The vision makes sense, but visions cost serious cash, especially when you are trying to compete in the most capital-intensive sector on the planet right now. Let's look at the financial realities, starting with their liquidity. Roan Group reported $220.5 million in total liquidity.
Which gives them a decent runway, but the composition of that liquidity is incredibly unusual for a publicly traded media and infrastructure company.
Wait, hold on. I'm looking at this balance sheet right now, and are they holding Bitcoin?
293.14 Bitcoin, to be exact, valued at roughly $17.2 million at the end of the quarter.
Why does a company building AI data centers have $17 million in crypto on its balance sheet? This is such a bizarre detail.
It is a highly unconventional treasury strategy, for sure. They are treating Bitcoin as a strategic reserve asset, which aligns with some of the broader alternative tech branding they've cultivated over the years. But the crypto ties don't stop at the treasury. You have to factor in their debt structure. They are carrying a $358.8 million convertible note payable to Tether.
A convertible note meaning Tether lent them over $350 million, and Tether has the option to convert that debt into equity like actual shares in a RUM group down the line.
Correct. And Tether isn't just a passive lender here. They are actively contributing to the top line. Tether accounted for $4.8 million in advertising revenue on the Rumble platform during the second quarter.
Wow. So there is significant cross-pollination between their debt holders, their advertisers, and their treasury strategy. It's an incredibly aggressive financial posture. And they need that capital because the cash burn required to execute this AI pivot is just staggering. They burned through $66.1 million in operating cash in the first half of 2026 alone.
And you really have to look at the capital expenditures. In Q2 alone, they spent roughly $47 million on IT CapEx.
That $47 million isn't going to marketing or software developers. That is the hard physical cost of buying the specialized server racks, the liquid cooling distribution units, the massive industrial transformers required to physically light up these AI data centers.
Exactly. And this capital intensity brings us to the primary risks for the stock going forward. The first is pure supply chain execution. Securing those liquid cooling systems and high-voltage transformers is a global bottleneck right now.
Yeah, everyone wants them.
Every major tech company is fighting for the exact same industrial components. If RUM Group faces a delay in securing transformers, it delays their ability to turn that 180-megawatt Atlanta site into revenue.
And the second major risk is integration. Merging a North American consumer video platform with a European high-performance computing company is notoriously difficult. You're dealing with different corporate cultures, integrating disparate software stacks, trying to align two completely different sales teams.
Those are legitimate headwinds, but despite those risks, Wall Street analysts ultimately re-rated the stock, largely due to the sheer magnitude of their forward-looking guidance.
Right, this is where the story shifts from a theoretical pivot to hard numbers. For the first time in company history, management issued formal revenue guidance. They projected Q3 2026 revenue to land between $87 million and $93 million.
To understand why the stock surged, you have to look at what analysts were actually modeling. The Wall Street consensus estimate for Q3 was hovering around $65.2 million.
So they didn't just beat the estimate, they guided roughly 38% above consensus at the midpoint. In this macroeconomic environment, a 38% guidance beat is almost unheard of. It is the kind of aggressive signaling that forces institutional investors to tear up their old spreadsheets and completely reevaluate the company's valuation.
Management is actively trying to force a structural re-rating. And to push that along, they announced a major change to how they will report their financials moving forward. Q2 will be the last time they report headline metrics like monthly active users, which sat at 57 million, and average revenue per user, which came in at 48 cents.
Because those are legacy media metrics. They're telling Wall Street, hey, stop grading us like a social media app.
Precisely the goal of CFO Mike Massey. Moving into Q3, they are transitioning to segment-specific financial reporting. They will break out the financials for Rumble Video completely separately from Quake AI. The digital advertising market commands a relatively low valuation multiple because it is highly cyclical and competitive. AI infrastructure, on the other hand, commands massive premium multiples because it represents contracted, high-margin, recurring revenue.
By splitting the reporting, they are forcing the market into a sum-of-the-parts valuation. They want analysts to value Quake AI as a high-growth cloud provider without dragging down its multiple with the ad-based video business. But they're essentially burning the boats here. By abandoning their old user metrics and projecting 90 million for Q3, they've set a massive expectation. What happens if this AI demand bubble bursts before they can get those 250 megawatts online in 2027? Like, what if the massive hyperscalers overbuild and the pricing power for AI compute just plummets?
Well, that specific bear case was challenged on the earnings call. CEO Chris Pavlovski was definitive in his response. He stated that he does not see AI compute capacity catching up with global demand anytime in the next 1 to 2 years. He described high-performance AI compute as very scarce. The thesis is that as the broader AI market expands from basic chatbots into real-time inferencing and autonomous agentic AI, the sheer volume of compute required will just outpace supply. RUM Group is betting billions that their infrastructure will remain highly coveted.
So bringing this all together, we have just watched RUM Group fundamentally alter its corporate identity in a single quarter. They survived a brutal algorithmic sell-off driven by one-time M&A accounting hits to ultimately convince retail and institutional investors that their transformation is legitimate. They are pivoting from a pure-play consumer video site into a B2B AI infrastructure heavyweight, backed by a massive 38% Q3 guidance beat.
It is a textbook attempt at a corporate reinvention. They are leveraging their existing data center expertise and their massive video archives to capture a highly profitable slice of the premium AI cloud market.
And whether you are a retail investor parsing through balance sheets, a tech enthusiast watching the global GPU wars, or just someone who occasionally uploads a video online, you are witnessing a real-time, high-stakes land grab. RUM Group is securing power, stockpiling GPUs, and aggressively laying the tracks for the next decade of the tech economy.
The execution risk on integrating Northern Data and building out the Atlanta site is substantial, but if they hit that 250 megawatt goal, the potential reward of a $3 billion revenue run rate completely rewrites the scale of the company.
Before we wrap up, I want to leave you with a final lingering thought to mull over. We talked about spatial temporal data. If our everyday video uploads, the gaming streams of vlogs, the random clips we share, if that data becomes the essential multi-billion-dollar fuel required to train the next generation of physical, robotic AI, how are the other legacy video platforms going to react? Are we about to see a massive wave of traditional media and social media companies desperately trying to transform themselves into AI data centers just to capitalize on their archives?
It definitely suggests the entire business model of consumer video might be on the verge of a massive pivot.
It's going to be fascinating to watch. Be sure to follow the show for daily earnings coverage, where we cut through the noise, skip the algorithms, and give you the fundamental analysis you need. See you next time.